Hello, everyone. Today's market reaction should not be read simply as Wall Street fell, because the real break was not that the Fed kept interest rates unchanged. It was the opposite. The Fed did nothing, but the market started pricing the possibility that the next move may not be a rate cut, it may be a rate hike. The S&P 500 fell 1.2%, the Nasdaq 100 declined 1%, and the Dow Jones Industrial Average lost around 1%. So the headline was no decision, but the market pricing sent a very clear message. After the first policy meeting under new Fed Chair Kevin Warsh, investors started asking a new question. Are we entering a new monetary policy regime? The Fed kept the federal funds rate unchanged in the 3.5% to 3.75% range. This was the fourth consecutive meeting with no change. And the decision was unanimous. Under normal conditions, that could have given markets some comfort. But this time, the issue was not the decision itself. It was the projections behind the decision. The Fed's updated dot plot showed just how divided the committee is on the path ahead. 9 out of 18 officials now expect at least 125 basis point rate hike this year. And 6 of those 9 officials expect 2 or more hikes. The remaining 9 members see either no change or a rate cut. So there is no clear consensus inside the Fed, and that is exactly what unsettled markets, because an economy that started the year expecting more easing is now pricing a rate hike by October. That is not a small adjustment, that is a shift in the expectation regime. Kevin Warsh's first press conference reinforced that message. Warsh said the committee would deliver price stability. He said persistently, high prices are a burden for American households. And he added that the recent past does not have to determine the future. The tone matters here. Because Warsh clearly moved away from the communication style of previous Fed chairs. He refused to provide his own rate forecast. He also played down confidence in his colleagues' projections. He said he did not feel a great deal of certainty in the meeting room, and he described the internal rate debate as a good family fight. That may sound like a soft phrase, but for markets, it means something very specific. There is a serious difference of opinion inside the Fed, and that difference is now entering market pricing. Institutional views also reflect this uncertainty. Goldman Sachs asset management strategist said the hawkish shift is not only about energy prices. They also pointed to strong labor market and inflation data. Morgan Stanley Wealth Management took a different angle. They argued that the Fed's next move is still more likely to be a rate cut once inflation falls enough. Edward Jones said the threshold for a rate hike now looks lower. But it also argued that easing Middle East tensions and softer oil prices could help cool inflation risks in the coming months. So the market is not pricing only one story. On one side, there is the risk of a more hawkish Fed. On the other side, there is the possibility that lower oil prices may reduce inflation pressure. That is what makes today's market reaction complicated. When we look at the Fed's own forecasts, it becomes clearer why the hawkish shift is being taken seriously. The median inflation forecast for this year rose from 2.7% to 3.6%. The 2026 core inflation forecast moved to 3.3%. The 2026 growth forecast was lowered to 2.2%, and the unemployment forecast was revised slightly lower to 4.3%. This is a sensitive mix for markets. Inflation expectations are higher, growth expectations are lower, but the labor market still does not look clearly weak. In that kind of environment, it becomes harder for the Fed to rush into rate cuts. Warsh also announced new task forces to review the Fed's communication policy, its $6.7 trillion balance sheet, data sources, productivity, and the employment and inflation frameworks. But he firmly rejected any reconsideration of the 2% inflation target until it has been credibly restored. So the Fed may review its tools, it may review its communication, it may review its balance sheet, but it is not backing away from the inflation target. That is one of the key messages for markets. Company news was also active. SpaceX shares fell for the first time since their record-setting IPO, ending a rally of nearly 50%. La-Z-Boy rose after fourth quarter earnings beat expectations. Unicure surged after news that it may be able to seek US approval for its Huntington's disease gene therapy without conducting a new study. At CME Group, long-serving CEO Terry Duffy announced that he will hand over the role to Chief Financial Officer Lynn Fitzpatrick on March 1st. These headlines did not change the overall direction of the market, but they showed that risk appetite is still working selectively at the stock level. In Europe, the tone was more positive before the Fed decision. The Stoxx Europe 600 ended the day 0.5% higher and reached a new record. Technology and banking shares led the advance. The optimism in Europe was supported by expectations that the peace agreement between Iran and the United States would be formally signed. The two sides are expected to sign the deal in Switzerland on June 19th. That step is expected to open the way for 60 days of talks aimed at ending the war and limiting Iran's nuclear program. But not every sector in Europe moved in the same direction. Automakers were the weakest performers. BMW fell 8.3% after cutting its profitability outlook and warning about weaker demand in China. That also weighed on Volkswagen, Mercedes-Benz Group, and Infineon Technologies, which has high exposure to the auto sector. On the positive side, buyers stood out. The stock rose 4.8% after its $7.25 billion settlement proposal for thousands of Roundup cancer lawsuits was sent back to a Missouri state court. In commodities and currencies, oil remained the main focus. Brent crude fell 0.4% to $78.66 per barrel. Oil prices have now fallen around 15% over the past 4 sessions, reaching their lowest level in 3 months. That move was driven by positioning around expectations that the Strait of Hormuz will reopen. Iron ore also fell 1.9% to $99.30 per ton, moving below the $100 level. Gold came under pressure from a stronger US dollar and the Fed's hawkish tone. Gold fell 1.7% to $4,256.93 per ounce. In currency markets, the US dollar strengthened broadly. The Australian dollar fell 0.7% to 70.13 US cents. The euro lost 1% and moved down to $1.1490. The British pound fell 1.1% to $1.3281. Bitcoin dropped 2.2% to $64,209. So the picture is clear. When the Fed turns more hawkish, the dollar strengthens. When the dollar strengthens, gold and risk assets come under pressure. And in oil, geopolitical expectations are pushing prices lower. Now let's move to the technical picture. For the S&P 500, the daily chart still shows an upward trend. The index is trading at 7,487.88. The 14-day TMA is at 7,466.41 and acts as the first dynamic support. The 50-day TMA is at 7,327.69. The 200-day TMA is at 6,913.57. The fact that price remains above all 3 moving averages shows that the primary trend is still constructive. On the upside, 7,500 and 7,750 are the key resistance levels. On the downside, 7,327 and 7,000 are the key supports. On the 4-hour chart, there is an important support cluster between 7,433 and 7,442. As long as that zone holds, the short-term technical view also remains constructive. The first target is 7,523. The next target is 7,700. But a 4-hour close below 7,300 could point to a deeper correction. The important point is this: the market sold off last night, but technically, the S&P 500 has not yet broken its main upward structure. For the DAX, the daily chart also maintains an upward bias. The index is trading at 24,960. The 14-day TMA is at 24,727. The 50-day TMA is at 24,481. And the 200-day TMA is at 24,216. This structure shows that the longer-term view remains positive. On the upside, 25,500 and 26,000 are the key resistance levels. On the downside, 24,481 and 24,216 are important supports, but the 4-hour chart is more neutral. Price is moving inside a compression zone between 24,644 and 24,889. The direction of the breakout from this band will be important for the short-term trend. Closes above 24,889 could bring 25,500 back into focus. A break below 24,644 could increase pressure toward the 24,400 supports. So in the DAX, the main picture is still positive, but the short-term market is in decision mode. Gold looks weaker. The daily chart is bearish. Price has broken below all three major moving averages. The 14-day TMA is at 4,321. The 50-day TMA is at 4,554. And the 200-day TMA is at 4,461. The fact that price remains below these averages shows that the previous bullish structure has deteriorated. 4,200 is the first important support. Below that, 4,050 becomes the next key level. On the upside, the 4,321 to 4,461 area has now become a strong resistance zone. On the 4-hour chart, there is some potential for a short-term rebound. That is because the SMI shows a positive momentum divergence. This suggests that price could attempt a move toward 4,325 and then 4,488. But that move should not be read as a full trend reversal. It would be a tactical rebound within a broader downtrend. A break below 4,150 would weaken that rebound scenario. The picture is much clearer in WTI crude oil. The daily chart is bearish. Price is trading at 76.941. The 14-day TMA is at 88.384. The 50-day TMA is at 95.826. And the 200-day TMA is at 74.393. After falling sharply from around 115 in April, oil is now below most of its major moving averages. That shows the strong uptrend from the 2025 and 2026 period has now broken down. The SMI is also extremely weak at minus 87.791. That is deep in oversold territory, but oversold conditions alone do not mean a reversal. In the past, similar levels were followed by further declines before price formed a meaningful bottom. On the downside, 74.39 and 70.00 are the key levels to watch. On the upside, 88.38 is the main resistance. The 4-hour chart also supports the bearish view. Price is below all three moving averages. 78.50 is the short-term rebound resistance. 74.00 and 70.00 are the downside target zones. Short-term bounces are possible in oil, but the main trend is still weak. Euro/dollar also shows a bearish structure. On the daily chart, price is at 1.15097, the 14-day TMA is at 1.15684, the 50-day TMA is at 1.16655, and the 200-day TMA is at 1.16743. Price remaining below all three averages confirms the bearish setup. The 1.1665 to 1.1674 area has become a strong resistance zone. On the downside, 1.14800 is the first critical support. If that level breaks, 1.14000 could come into focus. The 4-hour chart also shows price trading below all three moving averages. There is a tight resistance band between 1.15653 and 1.15875. Any rebound toward that area may face resistance within the broader downtrend. 1.14800 is the first downside target. After that, 1.14400 is the next level to watch. So, on a day when the dollar is strengthening, euro/dollar also remains technically weak. If we summarize today's market in one sentence, it would be this. The Fed kept rates unchanged, but markets read it not as a dovish pause, but as a hawkish pause. That is why equities fell, short-term treasury yields rose. The dollar strengthened, gold and Bitcoin came under pressure. Oil continued to fall on expectations around the Strait of Hormuz. In Europe, there was a record attempt, but weakness in auto stocks stood out. Technically, the S&P 500 and DAX are still holding their primary trends. Gold, WTI crude oil, and euro/dollar show a more clearly bearish picture. Today, U.S. weekly jobless claims will be watched at 22:30. The leading economic indicators index will follow at 0.000. These data points may help determine how seriously markets continue to price the Fed's new hawkish tone. For me, the most important message today is this. The market is no longer asking only, when will the Fed cut rates? The new question is, has the Fed really reopened the door to rate hikes? If that question gains more weight in market pricing, risk assets may need to adjust further. But if lower oil prices cool inflation pressure and the data confirm that trend, today's hawkish pricing may eventually stabilize. That is why the next phase is not about one single data point. It is about three forces moving together: the Fed's tone, the inflation outlook, and the direction of oil and the dollar, today's market action tells us one thing very clearly. Interest rates stayed unchanged, but uncertainty did not. Uncertainty went higher. And that is exactly what markets are pricing now. How do you read this market reaction? Is the Fed's next move really more likely to be a rate hike, or is this just a temporary hawkish repricing? Share your view in the comments. If you found this video useful, like the video, subscribe to the channel, and turn on notifications.